A very good evening to everybody. I am very happy today that I have managed to join this webinar from the train. Indirect tax is a very indirect subject for me. So I may not be able to give too much of an introduction, but whatever limited I know is that the law has now evolved over the last nearly 8 years. And there are several amendments which have been constantly happening. There is always a tussle between the center and the states regarding the sharing of the revenue. The GST Council also keeps on meeting frequently, keeps on tinkering a lot of the rates. Then, of course, as Sunil Bhai also mentioned, the input tax credit has always been a bone of contention for various sectors and industries. I occasionally read some of the articles which he publishes in the journal to try and at least gain some knowledge. Some of the sectors where there are problems mainly are in the real estate and in a lot of other industries. I'm sure a lot of the amendments which are there will be dealt with very comprehensively by Sunil Bhai. That BCAS is India's largest voluntary body of chartered accountants. Only 6 days, a lot of programs through. There are totally 10 committees, one of them being the Indirect Tax Committee. Plus, I think we also may publish a lot of books and publications. And our prized publication is our journal, which is now in circulation for more than nearly 60 years. Not only is it read widely by our members, but even non-members and a lot of other industry professionals and including government officials and bureaucrats. We also do a lot of advocacy, make a lot of representations on a regular basis on various tax matters, accounting and auditors, and various other aspects. So for those of you who are chartered accountants and not members, urge you strongly to become members as soon as possible. Gain a lot of benefit and career and journey. Thank you very much, everybody, and may God bless you all. Thank you.
Thank you, Zubin Bhai. It is indeed a pleasure to introduce Sunil Gabhawalla, sir. Sunil Gabhawalla is a chartered accountant in practice and is also a cost accountant. He had an excellent academic record with a rank throughout his career with the third rank in CA final. Sunil Bhai practices in the field of indirect tax and is one of the leading consultants in the matters of GST and erstwhile service tax and VAT. He has delivered lectures on topics of professional interest at various industry trade bodies. He regularly writes articles in various professionals and business journals and is regularly quoted in the newspapers on indirect tax related issues. His comprehensive treatise on service tax published by Bharat Law House runs in its 21st edition. Sunil Bhai has been actively involved in the policy formulation process of GST and actively follows a development in regard to this emerging law. His YouTube channel contains various videos on this topic. He mentors a pan-India community of indirect tax professionals on the front of GST implementation. Sunil Bhai is a past president of Bombay Chartered Accountant Society and a past chairman of the Indirect Tax Committee. He was also a member of the study group constituted by Maharashtra government and ICI for implementation of the GST. With this small introduction, I welcome you, Sunil Bhai, and request you to take this particular session forward.
Thank you, Mandar. Thank you, Zubin, for the introductory remarks and Mandar for the nice words of introduction. Of course, most of the participants and BCS being a home forum, most of the participants I would know by names and faces also. So honestly, that introduction was perhaps not that much required. But yeah, thank you for those kind words. And as Anand was highlighting, this is the second public meeting by the BCAS on the budget. And the first one was on the direct taxes. This one is on the indirect tax amendments proposed by the Finance Bill 2025. Zubin highlighted that indirect tax is a very indirect connection with an indirect tax. And when we look at the amendments, you will find that the amendments also have a very indirect way of presenting themselves as far as the indirect tax domain is concerned. Unlike a direct tax proposition in the budget, as far as indirect taxes are concerned, the amendments come in bits and pieces. And we are all aware that GST being the most significant of the indirect taxes, any decision or any amendment in the GST law requires a consensus between the center and all the states. And therefore, all of the aspects or the trajectory of the amendments are discussed beforehand at the GST Council, and it's only basis the recommendations of the GST Council that the amendments are proposed in the budget. And to that extent, therefore, whatever we would be discussing as amendments, while we will see certain things coming up in the finance bill, what is coming up in the finance bill would be only a tip of the iceberg. And there would be a lot of developments either prior to the finance bill proposal or thereafter. And therefore, when we look at any topic or any specific type of an amendment, we may need to walk back into history a bit, and also at times try to gauge a bit of the futuristic amendments which might come in. So in that sense, I would look at the topic which has been given to me, which is the budget, more as a foundation or as an anchor point, rather than saying that that's the start and the end of the discussion. And why would I say that is because if I have to just talk about the budget amendments, as you are aware, there are around 9 or 10 amendments in the GST domain. And if we want to speak about that, it's not going to be more than specifically restricting it to amendments, it's not going to be more than a 15-20 minute exercise. And I'm sure all of us have not joined here only for that type of a very simplistic type of a discussion. So we would be going into the detailing of each of those amendments and look at some concepts and the long-term impact of the amendments which are being proposed. With that background, yes, we will go into the detailed discussion of each of these facets. So with that background, what we are going to talk about is, of course, the comprehensive amendments brought in by the budget. And as we know that while GST is the predominant indirect tax today, we also have customs duty, and there are a couple of interesting amendments proposed in the customs duty as well. So we'll touch upon that. There are small consequential changes in the service tax and central excise duty. We'll spend a couple of minutes on that for the sake of comprehensiveness of the topic. But of course, the primary concentration is going to be the amendments in the GST law. And in that context, let's go to the first amendment which is being proposed. And that amendment is in the definition of input service distributor. The definition, as we are aware, was amended earlier last year to make the concept of ISD mandatory in cases where offices receives invoices for or on behalf of branches. And we have a lot of history, and we'll go into that history in a couple of minutes. But we are aware that yes, in the last budget, there was this amendment, and that amendment through a notification has been made effective from 1st of April 2025. Sum and substance of this amendment, earlier amendment, and the notification is that the ISD provisions become mandatory from 1st of April 2025. And prior to that, we all understand that these were interpreted to be optional, and there was a controversy around that, which was ultimately clarified by the government to be optional. However, when in 2024 Finance Act, the amendment was carried out, it was realized that that amendment was deficient slightly because while it covered the situations of domestic RCM under the intrastate supply and forward charge cases, it missed out the specific reference to services which are governed by the IGST Act and covered by RCM. And therefore, for that technical lapse, there was a need for an amendment in the definition. And that is what is proposed to be done by the Finance Bill 2025. The definition is sought to be amended to also include cases where tax has to be paid under reverse charge mechanism under the provisions of the IGST Act. And I would believe that it's just a suitable consequential amendment, not having a substantial impact on the overall concept. And that takes me to really the concept per se. Considering the fact that there is no amendment in Schedule 1 Entry 2, which deals with deemed supply and which has always been interpreted to cover situations where a head office provides services to branches or branches provide services to head office. The question comes in is, when you bring in ISD as a mandatory requirement, what is the scope of ISD and whether there will be a need to readapt or relook at the provisions of Schedule 1 Entry 2. And I think that is what we will spend some time in discussing, though not emanating directly out of the budget. I would believe that it's still a very important facet to be discussed. It has been discussed at earlier forums also, but for the sake of comprehensiveness, and since the law is now emerging in the near future, it may make sense to revisit some of those thoughts and look at the entire concept from a slightly different perspective. And I think the key issue, as I'm trying to bring out, is whether the concepts of ISD and cross charge are overlapping to each other. What would be governed by ISD and what would be governed by cross charge? And this is an issue which has been plaguing us ever since GST has been introduced, because both those concepts somewhere try to achieve a similar objective. And that objective is to bring in a balance between my output tax in a particular state and input tax credits claimed in that state. And therefore, we always felt that if there is input tax credit in state A and the corresponding revenues or output tax is being paid in state B, either you do an ISD to ensure that the credits in state A are transferred or moving to state B through the concept of ISD, or you may do a cross charge, implement Schedule 1 Entry 2 and raise an output invoice in state A and claim the corresponding credit in state B. In that sense, it was always felt that both those provisions are alternative to each other and one may choose either of them. Of course, at field formations, there were a little bit of challenge on this front. There were contradictory advance rulings and certain cases where notices were being issued. If ISD is done, notices were issued denying the ISD and saying it should be cross-charge. And if cross-charge is done, there were notices demanding ISD and saying that cross-charge is wrongly done. And in that context, 2 times the GST Council meeting, Council took up a cognizance of this issue. And in the 35th Council meeting, there was, in fact, the Law Commission had recommended a draft circular trying to explain in elaborate detail what is ISD and what is cross-charge. They took an example of a software company, a live example, and based on that example, they gave various situations and then laid down certain principles to explain that certain things can be ISD and certain things will be a cross charge. The proposition in that draft circular was that both of them are mandatory and both of them operate in different domains, and principles to explain this concept of a centralized procurement versus an internally generated service were being proposed in that draft circular. Friends, the GST Council, when they were discussing this Law Commission recommended draft circular, many of them felt that this is too intimidating and too overwhelming. And they felt that all of this is much ado about nothing. And therefore, that elaborate draft circular was not accepted. It was, in fact, specifically said that currently the GST law is not mature enough and the trade and industry is not prepared. Maybe the portal is not prepared. And therefore, that draft circular never saw the light of the day. It was not accepted. But as time progressed, in 2023, again, the field formations and advanced ruling authorities kept on taking conflicting propositions. And therefore, the matter had to be again taken up in 50th GST Council, where they clarified in favor of the taxpayer. And in a way, they tried to give a lot of benefits through a couple of circulars issued consequent to that council meeting. And what was the principles laid down in that council? The first circular they clarified very clearly was that the concept of input service distribution is optional. If an entity registers as an ISD, they can do ISD. If they don't register as an ISD, that is also okay. At the same time, they also said that at some point of time, we will make it mandatory. As far as cross-charge is concerned, they said that cross-charge, yes, Schedule 1 Entry 2 covers cross-charge, but they referred to the proviso to Rule 28 and said that if the recipient is eligible for full input tax credit, then the valuation done by the supplier unit will not be questioned. So in case the branch is eligible for full input tax credit, even if a head office is providing a support service, then whatever valuation is done by the head office for the cross charge or the support services given to the branch will be acceptable. The circular went a step further and said that if head office has not actioned out the cross charge activity at all, meaning they have not even raised an invoice, in that case, it will be assumed that a zero value invoice is raised and that zero value will be accepted. Further, it was clarified that in any situation, the salaries will not be a part of the valuation for this cross charge. Now, therefore, through this circular, certain relief, legally emanating from the provisions, certain reliefs which perhaps can be debated, but given through a beneficial circular were given as far as cross charge is concerned. As far as ISD is concerned, there also the relief was given to say it is optional. So, essentially, July 23 presented a scenario that it was a free for all, more or less, and people could do whatever they could. If they've done ISD, that is okay. If they've done cross charge, that is okay. If they've not done ISD and nor cross charge, that also is okay, so long as the end entity, end recipient, is eligible for full input tax credit. But as we know, in that council meeting, they had said that we will make ISD mandatory in the near future, and that future is now come. And therefore, there have been amendments in the Act rules and the notification, which I just talked about a minute ago, that ISD is now mandatory with effect from 1st of April 2025. Now, in this background, and considering also the litigations which have happened and which are ongoing over the last few years, we are all aware about the types of litigations we have been facing on this aspect of Schedule 1 Entry 2 as well as the ISD. We will have to now understand what is the scope of ISD and answer the question which was being raised earlier. And before we really go into that, let us for a moment go into that draft circular. We are aware that this circular never saw the light of the day and therefore is not legally enforceable. But unluckily, when you go to understanding the scoping of ISD from the government's side, except this draft circular, there is no elaborate guidance on what exactly is the distinction between an ISD and a cross charge. And therefore, I think I might still want to at least try to understand and decipher what that draft circular says, and then try to take a position on whether this aligns with the definitions and the legal proposition, or whether there is a need to relook at how we are interpreting the definition. So, as we are aware, the draft circular which is there in the public domain, and many of you might have read that circular, basically talks about an IT software company, and the diagram which you are seeing at the top is actually pasted from that draft circular. The table below is my table, but the diagram is definitely coming from that draft circular. And it talks about an IT software company which has a head office in one state, and it has two branch offices which are the executing units where the software is getting developed. Naturally, the circular highlights that each of these three is distinct person, and therefore for the purposes of GST, they are distinct entities. Thereafter, it defines various cross flows of services, external procured, internally procured, all those things. And all of that is explained through this diagram. So the first situation which the draft circular talks about is a case where the head office centrally procures services in the nature of security services. And it says that, look, there could be a situation where there are certain security people at the head office, certain at the branch 1 and certain at branch 2. And while those security is stationed at the respective branches and the head office, and services are received by those branches and the head office individually, the invoicing is handled by the head office. So the head office acts as a centralized procurement agency, and this is a word used in the draft circular. And then it goes ahead to say that in this situation, to the extent of the security deployed at branch office 1 or the branch office 2, the head office acts as a procurement agency procuring the security services for or on behalf of the branches, and therefore this should be a subject matter of input service distribution. So that is the first example which the draft circular talks about. Thereafter, it goes into a slightly different zone. It says that assume that the head office has an admin and an HR team which has various employees, and those employees help in, let's say, recruiting people across the country, including the branches, and provides various administrative activities, not only for the head office, but also for the branches. Now, for this type of a situation, the circular says that it is a situation where the head office, represented by its admin or HR team, is internally generating a service which is captively consumed by the BO1 or BO2. And this is where the phrase internally generated service gets coined. And then it goes ahead to say that this internally generated service will have to be valued and tax paid by the head office and credit claimed by the branches. Now, when it says all this, it also at that point of time said that salaries and all is a part of the valuation, which gets overridden because of a later circular. But yes, this is what the draft circular talks about. As a principle, the draft circular suggests that this is a internally generated service. The HR team, the admin team sitting in the head office, in turn, help generate a service by the head office for the purposes of branch. Similar example is given for the technical maintenance team, which might be providing various support services in the technical side to the branches. And thereafter, there is a B1 example where they are talking about one branch providing a support service for another branch by way of developing a software for a client served by the other branch. So all these examples have been given in the draft circular. Again, to caution you, it never saw the light of the day. But yet, this gives us a broad thought process about what is the ideology of the government in ISD. And as you can see here, the ideology of an ISD scoping is that the ISD is an office which acts as a centralized procurement agency for or on behalf of branches. And that has to be clearly contradistinguished from a situation where the office itself is generating a service to be provided to a distinct branch. Now, in that background, we now look at the definition of ISD. And when we look at the definition of ISD, we will find that this ISD is a concept finding its legacy from the excise rules and the service tax rules. The Senvet credit rules itself had a concept of ISD. And in this slide, I've tried to plot the definition under the Senvet rules, also under the CGST Act. And when I'm plotting it under the CGST Act, this is one aspect which is very relevant, is that at the phase when under the ISD, under the GST law, ISD was optional, we had a separate definition, and the definition was amended last year in Finance Act 24 when ISD was definition was amended to make it mandatory. The definition also got amended slightly, and while one might say that it's a slight amendment only to bring in the compulsory nature of ISD, I would believe there is a separate word here which also needs a lot of interpretation and deliberation. And perhaps what I find is that in many professional forums, that discussion is missed out. And that's why I think having all the three definitions on a single slide might be useful. Now, if we look at those three definitions, and while these are all verbose definitions, the essence we are all aware, and the important parts we have tried to underline. So if you go to the Senvet rules, the definition basically said that an ISD is an office which receives invoice and issues invoices for distributing the credit. So under the Senvet credit rules, an ISD in that sense was very wide. Any office which receives invoices and wants to distribute the credit can, to its different branches or whatever, can be termed as an ISD. And a similar definition was carried forward in the pre-amendment scenario of GST. So if you refer the definition pre-amendment with the old definition under the Senvet credit rules, you will find that the essence is similar. Here also we are using the words ISD means an office which receives invoices and issues a prescribed document, which we know is the ISD invoice, to a supplier having the same PAN. So again, the essence was similar, that if I am receiving as an office, I'm receiving an invoice and I want to distribute that credit, I can do that using the ISD concept. No strings attached. Now comes the post-amendment definition when ISD is made mandatory. In this definition, you will see that it starts still by saying an office which receives invoices and liable to distribute the credit. So this liable to distribute the credit creates the sort of a mandate which was missing in the earlier two boxes. In the earlier two boxes, it was and issues a document. So if I want to issue a document, I go into the ISD. if I don't want to issue a document, it's more factual rather than mandatory. But under the amended provision from 1st of April 25, it is clear that yes, if I am an ISD, there is a liability to distribute. And that is what is being discussed at various professional forums, and rightly so. What is being missed out at various forums is the highlighted portion in red, which says ISD is an office which receives tax invoices for or on behalf of distinct persons. Friends, make no mistake, this red highlighted phrase is introduced for the first time in the history of ISD. Over the last 12 to 14 years, earlier Senvet and thereafter the 7 years of GST, the definition of ISD was very much there, but this phrase for or on behalf of distinct persons was missing in all the earlier legislations and provisions relating to ISD. And that is where I think that while ISD is made mandatory, the scope of ISD is very restrictive. We need to understand the implications of this phrase before really saying that, okay, under the Senvet rules, I was doing an ISD for, people were doing ISD for statutory audit. Therefore, even under the April 25 amended definition, I will be doing an ISD of statutory audit. Before we conclude on that front, we will need to really question whether really statutory audit is a situation where the office is receiving an invoice for or on behalf of distinct persons. I am aware the opinions are divided on this front, and therefore I think I can explain this through an example which most of us can relate to. And I am taking this example not in this slide, we are not talking about the ISD and the mandatory nature of the ISD. We are talking of the past periods from 17 to 25. And the example which we are taking is a situation of a company, which let's say is in an infrastructure business. It incurs an advertisement expenses for brand building. So it incurs various expenditures towards, let's say, print media, television media, etc. And those vendors charge them a value of 10 crores plus GST of 1.8 crores. Now, typically, because there was a free play and maybe because of the interpretation at that point of time, maybe the ABC Limited had claimed the credit of this 1.8 crores in its head office registration in Maharashtra. Maybe it didn't have an ISD registration. At that point of time, ABC had factually 7 GST registrations in India. It had 2 overseas branches also. It also had a subsidiary in India, which is into real estate business. And that subsidiary, not only the ABC Limited's 7 plus 2, 9 branches, even the subsidiary uses the same brand in all its communications and in all its activities. Now, in this background, we are aware, and many of us might be facing these types of litigations and notices. In the past, ABC has already received 2 show cause notices, and it is litigating those show cause notices naturally. One show cause notice is issued by the DGGI, raising a demand of GST, saying that ABC Limited is providing a brand support service to its subsidiary. Because the subsidiary is not eligible for input tax credit being in the real estate business, the benefit of the proviso to Rule 28 is not available. Therefore, this service given by ABC Limited to its related person being the subsidiary should be taxed. Because there is no direct mechanism to identify a value, the DGGI says we will take 0.5% of the turnover of the subsidiary and demand 18% on it. And therefore, there is a show cause notice issued to ABC Limited saying that because you are rendering these brand services, please pay me a tax of this amount. Along with that, there is another show cause notice issued by the jurisdiction. And what the jurisdiction says is, look, you are rendering services. You are rendering services to your own branches. Some of them are in India, some are outside India. As far as India branches are concerned, they are eligible for full input tax credit being in infrastructure business. So I agree with that circular and I don't raise a demand. But you have 2 overseas branches. And for those overseas branches, they are not eligible for input tax credit. So I cannot give you the benefit of the proviso to Rule 28. At the same time, the taxpayer argued to say that this should be treated as export. And the department says, no, this can't be treated as an export because one of the conditions for export of service is that they should not be a part of a head office branch structure. They can be a distinct legal entity, but if they are distinct establishments of the same legal entity, then one of the conditions for export of service is not satisfied. Therefore, it is not really a case of an export. In fact, the department said that for covering these types of situations, we have given an exemption notification. And therefore, this should be treated as an exempted supply. And because this is an exempted supply, I want to trigger Rule 42. And out of this 1.8 crores, please reverse some amount of credits. So friends, it already has these two types of notices in its contingent liability, which it is litigating. And in this background, let us now look at the ISD provision, and assuming that the facts continue to remain the same, how are we going to interpret ISD for this example? And if we understand this in the correct perspective, maybe we will be able to win half or more than half of our battle. Admittedly, friends, I don't think anyone denies that advertisement is an externally procured service for ABC Maharashtra. Perhaps most of us might also believe that yes, the benefit of this advertisement is derived by not only ABC Maharashtra, but also by 6 additional Indian branches, 2 overseas branches, and the Indian subsidiary also. Therefore, a first-hand inclination is to jump ahead and say that this advertisement should become a part of ISD. And that is what is a dialogue floating around at various professional forums. And in that background, I want to just look at the entire situation slightly differently. Let's for a moment start by saying that yes, ABC obtains an ISD registration, informs the ISD registration number to the channels and to the print media, and ABC ISD claims the credit in the ISD number so as to distribute it. Now, we are all aware that the ISD distribution provisions apply only to distinct persons as defined under Section 25, which basically will cover the head office and the 6 Indian branches. So the 7 GSTNs will constitute distinct persons having the same PAN, and therefore there you can do the ISD distribution. But how do you distribute the credit to the 2 overseas branches and to the Indian subsidiary? Honestly, there is no answer to this question. The ISD provision does not permit a distribution to an entity having a different PAN. And as we are aware, the Indian subsidiary will have a different PAN. So if we say that this 1.8 crores of credit belongs to all these 10 entities, 10 different structures, I would say, 7 GSTNs, 2 overseas branches, and the Indian subsidiary, then how do I distribute 1.8 crores? I can distribute 1.8. I have to fully distribute it, and I have to distribute it in the ratio of the turnover. And I can only define the 7 Indian GSTNs as the recipients. So will I distribute it in the turnover of the 7 recipients to those 7 recipients? And if I do that, am I not indirectly distributing some expense attributable to a subsidiary or overseas branches to the Indian branches? And whether that will be acceptable and correct in the conceptual perspective. And what happens to my existing litigation? Essentially, the 2 litigations which we talked about dealt with a situation where the department is claiming that there is a service rendered by ABC Maharashtra to the subsidiary and to the 2 overseas branches. Will that continue or will that subside? And if that continues, are we saying that ABC Maharashtra renders a branding service to the subsidiary without it itself incurring an advertisement expenditure, because the advertisement is now attributable to the ISD? And if we really look at it, I'm sure all of you are confused with this example and there are no clear answers. And the reason why we are getting confused is because we perhaps are conditioned with the thought process that any common expenditure becomes ISD. Let's flip the entire situation and ask a different question. Can we look at this example to say that this is a case of an externally procured service in the nature of an advertisement, which is procured by the Maharashtra regular registration itself, so that it can further provide the branding services to the 6 Indian branches, 2 overseas branches, and the Indian subsidiary. And if we say this, then the current process of cross-charge, which many of the organizations have implemented, might continue here, even though there is a benefit, common benefit derived by the various branches. Now, this is where I think we need to synchronize and align with the thought process of for or on behalf of distinct persons. And if we really try to look at that entire situation with an open mind, maybe we may get answers which are more stable and more appropriate to implement the concept of ISD. With that type of a restrictive scope, and I would leave it to each participant here to independently examine how we would like to look at the ISD provisions, whether a very comprehensive scope in terms of anything resulting in a common benefit, or whether a restrictive scope of ISD. I would personally believe that the existence of the phrase for or on behalf of distinct persons grants a lot of support to say that it should be interpreted in a restrictive manner rather than in an all-encompassing manner. Now, assuming that we are aligned to this thought process that the ISD has to be interpreted in a restrictive manner, the question which comes is what all will be examples of ISD? Make no mistake, we are saying ISD is mandatory, but only in cases where the head office acts as a centralized procurement agency. And some examples which we can think about clearly are one example given by the draft circular itself relating to the security service, where the actual security service is received by the respective locations, but it's only as a matter of administrative or legal convenience that the PO is centrally raised and the invoice is centrally received by the head office. Similarly, you'll find examples where you can have 5 factories. The transport cost for all the 5 factories are centrally paid from the head office, and naturally, in that case, again, it's a centralized procurement. The actual transportation service is received by those respective factories. Similar case can be for customs clearance activity, courier services, etc. Going to slightly more tricky examples in case of services. One common example which I could see is an example where most organizations have a comprehensive insurance policy, maybe a group mediclaim policy or a personal accident insurance policy taken for employees or their families across all branches. Necessarily, the risk cover is at a decentralized level because the employees are decentralized. And here again, I would believe the office at the head office is more acting like an aggregator or a centralized procurement agency, and therefore that can become a part of ISD. Of course, someone might say, anyways, group mediclaim and all is an ineligible credit. We are aware that ISD requires that even the ineligible credit should flow into the ISD and the blocking should happen at the respective locations rather than a centralized blocking at the head office. Similar concept, I would believe, could apply for assets where for all India assets, you have taken a consolidated insurance comprehensive cover. I would believe that also would be an example of an aggregation and should fall within the concept of ISD. You have devices across the country, and for various devices, there are softwares installed. You obtain a single comprehensive license wherein a user-based fee is being charged by the vendor. I would believe these are again services which are centrally procured for all the branches. And again, that could become a subject matter of ISD. You might have a common travel portal where air booking is done for everybody across the country. Again, centralized procurement could become a subject matter of ISD. If you are an infrastructure company, you might have various projects across the country and you might allocate bank guarantees, and all those bank guarantees are centrally procured by the head office. Again, that could be a subject matter of central procurement of services and again become a part of ISD. So yes, some of these examples would be ISD, and definitely one would need to obtain a registration and comply with the ISD provisions, considering that it is mandatory. But I'm not too excited about saying anything and everything under the sun, like advertisement expenditure or brand building, or maybe even statutory audit or generic overheads, just because some benefit is arriving at the branch level. That by itself will not be the test for defining the scope of the ISD. That is what I would believe as far as the ISD is concerned. The law we are aware about, and this I think is also one of the reasons why I would like to align to this position rather than look at a very, very conservative position. And I think the key part here is section 21, which says that if there is any erroneous distribution of credit, excess distribution, then the excess credit shall be recovered from the recipients. Make no mistake, if we say that the invoice is raised to Maharashtra to ISD, and that invoice is distributed to 8 or 10 locations by way of ISD, and tomorrow that credit is to be questioned for various reasons. And we are aware that some reasons are genuine and many a times frivolous show cause notices are issued. Now we are told that those show cause notices in the ISD route will not be raised on the ISD, but on the individual recipients. And therefore, we are looking at a situation where your litigation can become, assuming you have 10 registrations, you are looking at 10x litigation to what is the current litigation level. You can have notices saying, asking you whether you have paid within 180 days or not, whether the vendor credit note has been accepted and whether you have reversed the credit or not, whether the matching is happening or not, whether the vendor has retrospectively cancelled his registration or not. We are all aware of the type of the litigations which we have seen over the last 7 years. Please understand that anything which goes through the ISD, and if there are 10 registrations, you are looking at 10x litigation on that front, contingent litigation on that front. And accordingly, decide whether in cases of gray, whether you would want to really conservatively just interpret it to be black or interpret it to be white. Of course, Rule 39, we are aware that the ITC available for a month is to be distributed in the same month in a very specific method. As I was highlighting, even for debit notes, credit notes, you have to issue an ISD debit note, credit note. And when you are issuing this credit notes, please note that the credit notes will have to be issued in the ratio of the original distribution ratio and not in the ratio of the current period. Now, this by itself can result again in a lot of ambiguity. And that's where I think there are two approaches. One is it's good to be conservative, but we shouldn't end up in a situation where we become so dogmatic that we try to implement something which is not implementable at all. So with that background, I would rest my discussion on the ISD and we'll move to the next amendment in the finance bill, which is relating to the definition of a local authority. And to this august audience, we are all aware of the relevance of the definition of local authority. There are two notifications. One notification which excludes certain supply of goods or services from the scope of supply itself by defining them to be neither supply of goods nor supply of services. And there we are told that if there are services rendered by a local authority to business entities in connection with a municipal function under Article 243W, then that is excluded from the scope of supply. All other services rendered to business entities by local authorities are under RCM. We are aware of that proposition. Contradistinguishing with this, we also have another exemption entry which says that if there are pure services not in the nature of works contract rendered by business entities to local authority, again in connection with that Article 243W municipal function, they are exempted from payment of service tax. Therefore, in both these situations, if there is an activity relating to a municipal function and that is vis-a-vis the local authority, then there is an exemption or an exclusion from taxation. Why? There has been a separate set of debate on what constitutes in relation to municipal function. That's a subject matter of discussion at some another forum. As of now, we are looking at this interpretation of the word local authority because both of these entries require that the services are rendered either by a local authority or to a local authority. And in that context, the erstwhile definition of local authority had various sub-clauses to it. And the relevant subclause is subclause C, which not only said that a municipal committee is a local authority, but it expanded the scope of local authority to include also any other authority legally entitled to or entrusted by the government with the control or management of a municipal or a local fund. And it is in this context that there was a lot of litigation which was brewing around both commercially as well as from the GST perspective, in situations where many municipal corporations have sort of, to ensure better accountability or autonomy or functional expertise, have tried to spin off some of the municipal functions to specially created authorities. For example, we have something known as a Delhi Jal Board, which is a separate corporation, separate from the Delhi Municipal Corporation. And the question then comes is whether the Delhi Jal Board can be considered as a local authority. And if there is a person providing a pure service to Delhi Jal Board, maybe in relation to water supply, which is a municipal function, whether he is eligible to claim the exemption or not. And this was something which was creating a debate or a confusion. And in that sense, the question which came up was what is meant by a local authority? And in some another context, few decades ago, the Supreme Court, I think in the late 60s, the Supreme Court had an occasion to interpret the phrase local authority in R.C. Jain's case. And this case was in the context of a Delhi Development Authority, DDA, whether the DDA can be considered as a local authority in the context of Payment of Bonus Act. And the issue basically was that, as you are aware, Payment of Bonus Act obliges employers to mandatorily pay a bonus to the employees. However, the act does not apply to local authorities. The DDA took a stand that I am a local authority, so I will not pay a bonus. And that was being aggrieved by one of its employees, R.C. Jain. And the issue therefore was whether DDA is a local authority in the context of Payment of Bonus Act. What the Supreme Court does is, it goes into the definition of local authority and says that this is not defined under the Payment of Bonus Act. So, I will just look at an anchor point from the General Clauses Act. And General Clauses Act also was not very clearly defining a local authority. And therefore, the Supreme Court goes ahead and says that, look, I will now define certain essential characteristics, certain tests. And it said that if an authority has to be defined as a local authority, it must be like a municipal corporation and possess many, and it's important to understand, it says possesses many, if not all, of various characteristics of a municipal corporation, municipal committee. So it tried to identify some 6-7 tests and said that, look, these are generally the attributes of a municipal committee, which is a local authority. So if something has to be, some other authority has to be a local authority, it should broadly contain these types of, it should broadly satisfy these types of tests. But it went ahead to say not all, many. It then also said, the Supreme Court also said that, however, it must possess one essential feature, and that is that it should be entitled to control and manage some fund, a local fund which has been entrusted to it by the government. And after looking at the facts of that case, it's ultimately concluded that the DDA is a local authority. Now, this is, of course, under the Payment of Bonus Act, a 4 decades old decision. And someone might say, this, what is this context in the GST? And the context in GST came up in an advance ruling application filed by Indian Hume Pipes situation. The AAR was against, the matter went to the AAAR. And in these decisions, in these rulings, the advance ruling authorities went back to this R.C. Jain's case. What the AAAR does is, it goes to this R.C. Jain's case, picks up those 6 illustrative attributes, and it starts by assuming or saying that all these 6 attributes have to be satisfied, even though the Supreme Court said that only many of them have to be satisfied, not all. The AAR starts with an erroneous, with due respect, an erroneous understanding that all the 6 tests have to be satisfied. And thereafter it analyzes them and says that 3 of them are not satisfied. This was a case, not the Delhi Jal Board, but this was a case of BWSSB, Bangalore Water Supply and Sewerage Board, which is a spin-off from the Bangalore Municipal Corporation. So in that situation, the AAAR says that 3 tests are satisfied, but 3 are not satisfied. And what are not satisfied? It said it must function in a defined area and must ordinarily be elected wholly or partly by the inhabitants. They said BWSSB officials are not appointed or elected by the inhabitants of that area. It misses out the fact that the Supreme Court observed that it can be an indirect appointment. It then goes into saying that one more test is not satisfied, that the authority must enjoy a certain degree of autonomy, which should be appreciable. And it says that, look, ultimately, a lot of decisions have to go back to the commissioner of the Bangalore Municipal Corporation. And if that be the case, BWSSB does not enjoy that degree of autonomy. Again, if we look at the Supreme Court observation, it says that a certain degree of autonomy, it doesn't say complete. So that again, with due respect, was slightly given a little bit of a different interpretation. And finally, it says that the authority must have power to raise funds. In this case, BWSSB was directly charging fees, but it was not raising additional funds in other manner other than fees. And therefore, it says that there is no control or a fund given by the Bangalore Municipal Corporation, and therefore it does not qualify. So on these 3 grounds, the AAAR suggested that BWSSB does not qualify as a local authority. I am aware BWSSB itself is litigating this matter in the courts, and it is therefore in that sense sub judice. And in that background comes the amendment in the Finance Bill 25. What is proposed is there is a separate definition given through an explanation for municipal fund and local fund. Of course, in this context, municipal fund definition is more relevant rather than local fund. The definitions are similar, except that local fund refers to panchayat, municipal fund refers to municipality or a metropolitan area. So how are we defining it? Municipal fund, we are told, means any fund under the control or management of an authority of a local self-government established for discharging civic functions and vested by law with the powers to levy, collect and appropriate any tax or fee by whatever name called. Now, if we really read this and benchmark this definition against the situations of BWSSB or Delhi Jal Board, we may come to a conclusion that indeed these authorities are set up under the control or management of the governments which are mentioned herein, and they are vested with functions related to the municipal functions, and they do have power to collect levy and appropriate the fees. And therefore, one may need to relook at the correctness of the AAAR of Indian Hume Pipes and a couple of more AAARs to that effect. And maybe one may need to relook at the positions in this regard. So that is where I think this amendment brings in a little bit of more clarity on this entire proposition. I would have preferred if they would have amended the law the way it was prior to 2022, where they had not only given the exclusion for local authorities, but also to governmental authorities. The problem would have been nipped in the bud, but rather than doing that, they've chosen to just amend the definition of the local authority in this manner. That takes me to the next amendment, which basically reflects the level of mistrust which is existing between the government and the taxpayer. We are aware of series of amendments in this regard, right from the basics of e-way bills, wherein we tracked the movement of the goods, to the IRN, wherein we tracked the creation of the invoices, to the invoice management system itself, where we are tracking the credits and the output taxes paid. We are now going a step further. We are saying even if there is no movement of goods, or even if there is no invoicing or transactions, certain goods are themselves so prone for misuse or abuse that we want to bring in a track and trace mechanism for goods by themselves. So they are saying that for these types, the government is empowered to prescribe a class of goods for which the moment the goods are manufactured, there will be some mechanism of identifying the goods or tracking the identification of the goods. So something like an RFID tag or something will be defined, and you will be expected, assuming that good product is a part of the prescribed goods, the manufacturer or the trader will be expected to affix this identification on those goods, and there will be an obligation that there is a tracking of the location of these goods available on an online basis electronically. And then there are penalties which are prescribed for non-compliance with the provisions. So essentially, this is an enabling provision. I would believe that we are going into a zone of just too much of over-regulation. But well, we will have to wait for what types of goods get prescribed and the manner and mechanism of this track and trace to really see how it gets ultimately implemented, whether it results in any additional perceptible revenue to the government or whether it just complicates the ease of doing business at a business level. So with that little bit of a discussion, I think we go to the next amendment. Again, a sort of an innocuous amendment as a follow-up to something which was already decided by the GST Council and which was reflected in the CBEC Circular 243 issued recently in December 24. And we are aware that this entire vouchers business, where various organizations issue vouchers. And because there was a time of supply provision defining vouchers, wherein there's an identifiable supply and a non-identifiable supply and the timing of payment of tax, there was a lot of controversy on how do we deal with taxation of vouchers. And a lot of litigation was floating around on this point. Through this circular, the CBC brought about the principles of clarification for the vouchers. And it basically went ahead to say that when you look at vouchers, many of those vouchers can be prepayment instruments as defined under the RBI law. And if they are PPI instruments, then the CBC circular clarifies that these are actually transactions in money. And therefore, at the time of issuance of vouchers, no tax is payable. Of course, at the time of redemption, there is a supply of goods, and naturally the tax would be applicable on that supply of goods at the time of consumption or redemption. As far as non-PPI instruments are concerned, the circular goes ahead and says that this can be considered as actionable claims. And therefore, actionable claims are also outside the purview of GST, and therefore, no tax is payable even in case it is a non-PPI instrument. Sum and substance, after a lot of discussion, what we are saying is, irrespective of the type of the interpretation of PPI or non-PPI, at the time of issuance of vouchers, no tax is payable. Now, as we are aware that in the industry, the voucher doesn't directly move from the original entity issuing the voucher to the end consumer who is going to redeem the voucher. There are intermediaries, there are traders in vouchers. So there will be, a distributor who will buy vouchers, let's say from Amazon or from Kalyan Jewelers or someone like that, and then sell it ahead. Now, these types of intermediaries also, there is a clarification to say that these intermediaries can be acting on P2P or P2A basis. If they are buyers and sellers of vouchers and acting on a principal to principal basis, then again, they are not liable because they are not providing a service to anyone. And as clarified earlier, these are either transactions in money or actionable claims. If intermediaries are acting on a P2A basis, the circular says that yes, in this case, they are providing a service to the issuer, and therefore the fee or the margin earned by them is liable for GST. At that same time, they also clarified that the base value of the voucher itself will never be liable. Only at the time of redemption and consumption that it becomes liable. Next question which comes up is, what happens if the voucher is not redeemed at all? As we are aware, every voucher has a time limit of expiry. And in many cases, people don't redeem before that. And if they don't redeem, then naturally there is a indirect income which the issuer earns, wherein he does not supply any goods, but yet he has to write back this amount maybe 2 years or 3 years down the line as other income. So this also, the CBC circular clarifies that this breakage value is not liable for GST. Such a comprehensive circular, very nice, and in a way, yes, explaining the principles well. The only problem was this circular was conflicting with the provisions relating to time of supply, because we had section 13 and 12. Both of them had a very elaborate provision mentioning that if there is a supply of vouchers, supply through a supply of vouchers, if the voucher is having an identified product or a service, then upfront you pay the tax, otherwise you pay at the time of redemption. Naturally, it was in stark contrast to this circular. Therefore, Finance Bill 25 respects this circular and the GST Council decision, and it omits those provisions relating to time of supply. So that's the only change which has been proposed as far as the Finance Bill 25 is concerned. That takes me to the next change, which is again a important, far-reaching and widely discussed matter relating to credits under sections 17(5)(c) and D. All this issue, of course, we are aware, started with a situation of a person who was constructing a mall to further rent it to various tenants. And it wanted to claim the credit of the goods or services which it had procured for the purposes of construction of a mall, which in turn was to be let out. And while he claimed the credit, the department took a stand that these goods or services are used for construction of an immovable property, and therefore the credit is blocked under section 17(5)(d). Orissa High Court gave a favorable verdict. It said that it interpreted these provisions to say that the credit is available. Matter went to the Supreme Court. Supreme Court in Safari Retreats, the celebrated case, not only analyzed 17(5)(d), but somewhere dragged in the concept of 17(5)(c) also, and went into a detailed discussion on the constitutionality. It held that the provisions of 5(c) and (d) are constitutionally valid, but thereafter it went into interpreting C vis-a-vis D. And it said that both these provisions, C as well as D, have carve-outs. And there are two carve-outs. Specifically in the context of D, there is a carve-out which says that if the construction is not for your own account, then credit is available. And it also said that the credit is available if the construction results in something which is other than plant or machinery, something which is a plant or machinery. So after highlighting these two carve-outs, the Safari Retreats goes ahead and says that, look, you are using the word plant. The department argued that, look, we have a definition through an explanation to specifically exclude lands, buildings, and civil structures from the definition of plant and machinery. The Supreme Court says that, look, that definition, the explanation uses the word plant and machinery. The word plant and machinery is used in 5C, but in 5D, the use of the word is plant or machinery. And I think there is a difference between and or. This is what the Supreme Court said. The ASG says, is on record in the judgment to say that this or is a typographical error. The Supreme Court analyzes this argument and says that no, we don't see this to be typographical. There are various reasons why we believe that this is intentional. The law intends, the legislature intends to have a different carve out for D as compared to C. And therefore, based on an interpretation of and versus or, it said that if you are fitting within subclause D, which is itemized procurement of goods or services, in specific fact matrix, a building may constitute a plant, and if so, you would be eligible for credits relating to those buildings. That was one carve-out which was discussed in that decision. Another carve-out which was discussed in that decision was that if the construction is not for your own account, then credit is available. And in this context, the court also analyzes that when a construction is not on your own account, and naturally, if the person who is getting the building constructed is getting it constructed for further sale, it is not on own account. The Supreme Court also says that if the building is intended for further lease, because Schedule 2 treats the lease of building as a supply of service, therefore, even in that situation where a mall is being constructed for further letting out, such letting out is also not for own account, and therefore credit should be available. So these are the two observations of the Supreme Court. Naturally, any favorable decision, there is always an inclination from the government to plug that decision. And that was what happened. The GST Council recommended that this decision should be nullified through a retrospective amendment. And the Finance Bill 2025 tries to do that. And it tries to do it in a simplistic manner. It replaces the word plant or machinery by the word plant and machinery. And once it does that, a substantial part of the Safari Retreat Supreme Court decision becomes redundant, considering the fact that this amendment is done retrospectively with effect from 1st of July 2017. Therefore, the discussion that there is a difference between plant or machinery and plant and machinery will no longer survive. But friends, the earlier carve-out observed by the Supreme Court, the situation where the construction is not for your own account and the interpretation that when I am constructing something for further leasing, that construction for further leasing is not a construction on my own account. That aspect apparently is not being addressed by this retrospective amendment. And therefore, that continues to be a subject matter of interpretation even post the amendment proposed by the Finance Bill 2025. That takes me to the next amendment relating to the credit note. And it's a simplistic type of an amendment in section 34, which basically says that if you choose to claim a self-adjustment of tax, and we are aware that as a supplier, when I issue a credit note which bears the GST impact of it, that credit note will result in a reduction in my tax liability, which gets self-adjusted against the other output tax of that particular month. And that's where section 34 is sought to be amended to say that this self-adjustment of tax on account of credit note will be permitted to a supplier subject to a condition of recipient reversing the input tax credit if he had already claimed at the time of the invoice. And of course, we are aware that since October 24, this sort of provision has been already implemented in the IMS. In invoice management system, which today is optional, but to the extent of credit notes has become mandatory, we are aware that the guidance says that if a supplier issues a credit note, the recipient is not permitted to keep the credit note pending. He can either accept or reject the credit note. If the recipient accepts the credit note, his ITC gets reversed. And if he rejects the credit note, then the self-adjustment is denied to the supplier. And this has already got implemented in that sense, though there was no legal backing. Maybe this amendment gives that proposition a legal backing, but it has already created a lot of furor and heartburn or practical problem as far as various taxpayers are concerned. And in the months of December and January, we have seen that there has been a lot of impact coming up in terms of tax returns filing by various entities on this account. And I would believe the primary impact is not on account of a rate difference credit note. The primary impact arises in cases where a supplier unilaterally generates a cancellation credit note to nullify an erroneous invoice. And we need to understand the business dynamics to really appreciate this facet. We are aware that most of the businesses work on ERPs, and because of the audit trail and the locking in the ERPs, most of those ERPs do not permit cancellation of a document once it has been generated. Why go very far? Even the IRN generated, the invoice registration portal, and anybody having a turnover above 5 crores has to generate an invoice through the IRN route, permits a cancellation of an erroneous invoice only within 24 hours. Now, naturally, you cannot expect a human being to be perfect like God. There will be cases where an organization, a human being there, when he generates an invoice, there is some error in the invoice. And if there is an error, let us say instead of invoice bearing a GST number 1, bears a GST number 2. Naturally, that invoice is an erroneous invoice. And if you want to nullify that invoice, the only way you can do it in an ERP or even on the IRN portal would be to issue another credit note to nullify that invoice. And this, I would say, are examples of unilaterally generated cancellation credit notes. These cancellation credit notes, neither the invoice or the credit note has reached the recipient. Many a times the recipient may be a stranger to the transaction at all. You might be not having any dealings or business association with that person. Because if you change the invoice number, GST number 1 to GST number 2, it could be of some random number person, somebody else in the country. So in these types of situations, we are ending up with a problem. And the problem is, how does, as a supplier, I demonstrate that the recipient has reversed his credit? As I was highlighting, the IMS is trying to do this through an action to be taken by the recipient. And the thought process is that if I have erroneously generated an invoice and a credit note, the recipient, when he sees both those documents in his IMS, we will reject both those documents, which is a good and I would say a happy case type of a situation. And it also says that, okay, what happens because IMS was implemented only from October 24, what happens for past period? There we have a circular which says that you can obtain a certificate from the recipients for the past period. Now, the problem is life is not working on a happy case scenario. And for understanding that, we will now have to step to a situation at the recipient's end. And the example we are taking is a situation where the supplier A has wrongly issued an invoice favoring B and immediately issued a credit note to cancel that invoice, again favoring B. Now, this invoice as well as credit note, he naturally has been uploaded in the portal, and the proposition, because of the amendment and because of the IMS, is that the credit note adjustment, the minus adjustment of 100 on the credit note against the 100 rupees of tax payable will be permitted only if the recipient, Mr. B, accepts the credit. Now let's step into the recipient's shoes for a minute. And there could be various situations. And those situations, many of those situations I will classify into the first factual basket, where I would say that the original invoice credit, the credit on the original invoice of 100 rupees itself, was never claimed by the recipient. Technically, if the recipient B is a stranger to the transaction, just because credit is appearing in his 2B, he can't claim it. He has to receive the goods or service. So ideally, he wouldn't have claimed the credit. He's not correct in claiming the credit if he has claimed. And most of the situations are situations where the recipient wouldn't have claimed the credit. And there are variations to this. The first variation is the recipient has implemented IMS. So what he does is every month he diligently downloads the data from IMS, compares his books of accounts with IMS. Whatever is matching, he claims. Whatever is not matching, he would ideally keep it pending because he has no visibility. The tax person in that recipient's team does not have the visibility to know whether the invoice is a genuine invoice which is still to be booked in the system, or whether it is an invoice created by error by the third party. So he would not want to action anything out on the invoice. He will keep it pending. That is one situation where he has not claimed the credit and the invoice is pending in IMS. Naturally, he will not want to reverse the credit here. So what will he do? He will reject the credit note. Yes, ideally, he should go back to the IMS, check whether there is a corresponding invoice, and then either reject both or accept both. But as we are aware, in the crunchy timelines and in volumes, he may not have the time to do all that. And if he does not have the time to do all that, he will choose to keep the invoice pending and reject the credit note. Second situation is he has not implemented IMS. The recipient has not implemented IMS. If he has not implemented IMS, then invoice is deemed to be accepted. And therefore, this deemed accepted invoice, ultimately it goes into his GSTR 2B. And then when he does the matching in GSTR 2B, he realizes that this is not in his books. So he does a temporary reversal. We are aware of Circular 170, which requires an entity to match books with 2B. And if the transaction is not in books but in 2B, he has to choose either a temporary or a permanent reversal depending on the situation. So he has either done a temporary reversal relating to a post-IMS transaction or even maybe pre-IMS transaction. It has already been disclosed as a temporary reversal. So effectively, he has not claimed the credit. Will in these situations he accept the credit note? Again, the answer is no, because in both these situations, he has already reversed the credit. Effectively, he has not claimed the credit. Now, if he accepts the credit note, it will automatically result in a second reversal of a credit, which he has never claimed effectively. And therefore, in these situations also, it's likely that he will reject the credit note. Of course, I'm sure some of us will say that there's a workaround. The person should reclaim the temporary reversal and then reverse it by accepting the credit note. Yes, if he wants, he will do that. But if he does not want to do all that and mess his GSTR 3B, he can very well say, why should I mess around with my records as a recipient just because some person in the supplier's organization has made an error? And again, everyone will take a different type of a call in this type of a situation. Next situation is a case where the invoice was disclosed as a permanent reversal. As we are aware, if it's a temporary reversal, you can still reclaim it. But if it was disclosed as a permanent reversal, then the reclaim might result in an imbalance in credits and auto-generated notices at the recipient level. So therefore, reclaiming a permanent reversal can be a much larger challenge for the recipient. And in this situation, there's really a much larger resistance or a friction at the recipient's end in accepting the GST credit note. So again, he will go ahead and reject it. Again, there is a pre-IMS invoice which was not actioned out. Circular also was not followed. Therefore, effectively, there was no credit claimed anywhere. It's not lying anywhere as a suspense. And therefore, in this case, if the person is rejecting the credit note, again, there is a additional reversal which is not required. Same way, there could be a situation where the supplier has delayed the credit note and the recipient has already reversed suo moto earlier. So second reversal he will not do. So in all these situations, it is very likely that the recipient will reject the credit notes. And if the recipient rejects the credit note, the supplier ends up with paying a tax despite there being no supply at all. And that's where I think the situation gets really very murky. And the question which comes up is, what is the way forward? I think there are honestly the way the portal works. And now with the amendment in the law, there is going to be a bit of a challenge on this front. And I think the only way forward would be to A, minimize the situations of these cancellation credit notes. And even in cases where you are stuck with a situation that you have a cancellation credit note, and as a document, you might have generated it in your ERP and you might have generated an IRN. Maybe before uploading your GSTR1, try identifying those contra entries of erroneous invoices and cancellation credit notes and try to avoid uploading those documents in GSTR1 itself. In a sense, net out both the contra entries or the documents before the uploading process so that this challenge of netting out does not arise at the portal or at the IMS level. I am aware that if you try to do this, there will be a mismatch between the documents as per the books and as per the IRN. Mind you, it will be a mismatch at a gross level, at a net level, things will match and queries may come in. And if those queries come in, the taxpayer can explain the situation that these are examples where the credit note was issued for cancellation. And because the credit note was issued for cancellation, we have implemented that cancellation in spirit before filing and uploading the return. I think that would be also a possibility which organizations may need to examine as compared to trying to entering into substantial controversies with the as commercial disputes with the customers or the stakeholders. So that is one facet which we need to bear in mind. The next amendment pertains to supplies by SEZ or FTWZ units. We are aware that Schedule 3 Clause 8A as of today says that supply of warehouse goods to any person before clearance for home consumption is excluded from the scope of supply. One would interpret that this provision should cover situations where an SEZ unit or an FTWZ unit is internally supplying goods to another SEZ or an FTWZ unit. And maybe ultimately those goods are even getting re-exported. But there was an interpretation floating around that because this entry talks about the phrase before clearance for home consumption, in cases where the goods are not intended for further home consumption at all, we have a lot of situations where goods are imported for intermediary processing, basic processing like packing, repacking, etc. in an FTWZ area with a clear intent of really re-exporting it rather than bringing it into the home consumption or the domestic area at all. So there was a bit of a controversy brewing on that front. So to avoid all that and nip it in the bud, we have an additional clause 8AA inserted with retrospective effect again from 1st of July 2017 to specifically say that if there are any supply of goods which are warehoused in an SEZ or an FTWZ before clearance for exports or to the DTA, in all those situations, the transactions will be excluded from the scope of supply and therefore no taxes will be paid. So in a way, it's a good proposition, but I think the only challenge continues to remain is regarding the services rendered by FTWZ units. If especially these services are rendered to a domestic entity there will be a tax implication, and I think the industry itself agrees that there is a tax and the credit is available to the domestic customer. But if an FTWZ unit renders service to a foreign customer and the services are such that the place of supply is ultimately held to be in India, for example, being in the immobile property basket or the performance-based basket, there is a bit of a challenge because services rendered by SEZ units are not exempted or exported. The definition of export would still have to be satisfied by the SEZ unit. And the definition of export, one of the conditions is that the place of supply should be outside India. So therefore, there is a bit of a challenge here where a FTWZ unit renders a local service to a customer located outside India. So that is one challenge which continues, and maybe as time progresses, we might see some future amendment in that regard. We'll just touch upon a couple of miscellaneous amendments. We have, again, these amendments are coming from the portal implementations which have already been done. Section 38, we are aware, talks about auto-generated GSTR to be. Now, because GSTR to be based gets generated based on iterations of IMS, therefore they have dropped the word auto-generated and they said that it's generated in the manner prescribed. Similarly, Section 39 talks about GSTR 3B, where the government takes upon itself the powers to prescribe conditions and restrictions in filing the contents of GSTR 3B, perhaps hinting at a discussion which was floating around in the GSTN portal to say that the 3B figures will get auto-locked. And of course, thereafter they had removed that and said that no, this is not right now getting implemented. Maybe at some point of time we will implement it. And to implement that, perhaps the Section 39 has been amended to prescribe conditions and restrictions of filing of GSTR 3B. And finally, in case of penalty or only orders, a couple of small amendments. Section 107 deals with the filing of first appeals. There we are told that earlier the pre-deposit was 25%. It is now reduced to 10%. And as far as the second appeal before the GST appellate tribunal is concerned, earlier there was no pre-deposit. Now an additional 10% pre-deposit is expected in case of penalty-only orders. So with that, we close on the GST-related amendments. I would spend 5 minutes talking about 2 or 3 important amendments relating to the customs duty domain. And for the first time, because the matters of provisional assessment take a long time and many a times it remains open-ended, we are now bringing in a time limit of 2 years for finalization of provisional assessments. A welcome step. Of course, there are certain exclusions from that, but at least it bring in a early closure to various contentious issues in terms of valuation of or a rate of duty of certain imports. A second and a very welcome step is a voluntary revision of a bill of entry. And as we are aware that a bill of entry by itself, though it is filed by the taxpayer or the importer, itself constitutes an assessment. And therefore, once the assessment is over, an assessment by the customs officer, therefore, generally a revision is not permitted. And as of today, if you want to amend a bill of entry, you have to specifically apply, and there's a long procedure for that. And to avoid all of that, we are now providing for a voluntary revision of a bill of entry post clearance, whereby if you have identified that instead of paying a basic custom duty of 15, you had paid 10, you can voluntarily pay the differential duty along with interest. Same way, if you feel that you have paid more, you can file a revised bill of entry for a lower duty and thereafter claim the differential refund. The timeline of 1 year has been prescribed for claiming that differential refund in these types of situations. So I think it's again a welcome move, which will permit a revision of the bill of entry in these types of situations. A cosmetic change both in customs and excise is that the settlement commission is now sought to be replaced by an interim board of settlement. So there are consequential amendments to that effect. Lots of changes in the customs tariff itself because we want to merge the various customs duty rates into specific bands of rates. I'm not going to the specifics. The respective players would anyways know about the rate change which has happened either because of this rationalization or because of change in the rate notifications which further provide a partial or full duty exemption. And finally, there is a change in the import of goods at concessional duty rate. So for manufacturers, if they are importing goods, certain type of goods are eligible for a concessional duty based on an end use. And as we are aware, today the end use period is 6 months. The 6-month period of end use is now increased to 1 year. And those entities have to file a statement explaining the procurement of the concessional goods and its utilization towards the defined end use. That statement, which was originally to be filed on a monthly basis, now is to be filed on a quarterly basis. Again, this will help a little bit in the ease of doing business part of it. Settle excise, the single amendment is the settlement commission replaced by the interim board. As far as service tax is concerned, it keeps on haunting us. 2017 is long over. But yes, there is a retrospective exemption given for a specific reinsurance service under a particular type of a scheme. And that retrospective exemption dates back from 2011 to June 2017. I'm sure it's celebration time for those people who were providing these types of services. And with that type of a celebration note, let me wind up my discussion on the proposals of the Finance Bill 2025. I'll hand it over back to the organizers for the next steps.
Yes, thank you, sir. Thank you to the audience also. And before I proceed for a wonderful vote of thanks for wonderful deliberations by Sunil Bhai on not only on the GST aspects, but the overall indirect tax proposals of this public lecture meeting, I would first like to announce certain announcements on behalf of the society. The first one would be there is a webinar scheduled for the new income tax bill on 18th of February next week. Request everyone to keep watch out for the formal announcement which would be made, and you can check the details on the BCS website. Additionally, there are multiple programs which are also been announced by the BCS. I would first start with an indirect tax committees program, this being an indirect tax program. The flagship program of the indirect tax committee, that is the 19th residential study course, would be held on GST, would be held at Kolkata. This would be in the month of June, between 12th to 15th of June. And the announcements will be updated on the portal for further details. Moving to other RRCs, there are two more RRCs which are being announced by BCS. The first one is the residential study course on Ind AS. That will be between 20th of March to 22nd of March. Then the another format of RRC by the International Tax Committee, which is International Tax and Finance Corporate Conference, which will be held between 3rd April to 6th April at Jaipur. Apart from that, various workshops and programs are being conducted. One would be by the Finance and Corporate Allied Laws Committee on REITs and InvITs as investment avenues. The next one is Writers Workshop on crafting words and creating impact. That would be on 20th of February. One-day conference on practical issues under FEMA on 22nd February. Then for the students, we have Tarang, the 7th Jal Iraj Dastur CA Students Annual Day Conference on 22nd of February. The residential refresher course, which is the registration has been full, but I would like to announce that this year they are going the 58th residential course. It would be held at Lucknow, coupled with a visit to Ayodhya Ram Mandir. Then Finance Corporate Allied Laws Study Circle meeting on how to read and analyze annual report. A full day event on ESG essentials on importance, implementation and reporting. It would be held on 4th of April 25. And CA MBA, that is the CAMBA 2025, would be held between 11th April to 13th April. So for all the details, announcements and the details of these programs, you may please check in the BCS websites or the mails which you are already receiving. Coming to a task of proposing the vote of thanks to our today's faculty, CA Sunil Bhai Gabhawalla. I think there is no doubt amongst any one of us that the way Sir has done a comprehensive coverage and he has read not only in between the lines, but across that and given us a total 360-degree perspective, a detailed analysis of the ISD mechanism, as well as the implementations and implications of the Safari Retreats judgment, which are getting amended retrospectively by change of words from plant or machinery to plant and machinery. I think it will be a really good thought process and a good food for thought for all the indirect tax professionals to take their advice, decisions, and carry forward to your own clients. So with these few words, I request the August gathering to please appreciate the efforts of our speaker today with a loud round of applause. Thank you, Sunil Bhai. Thank you on behalf of the society, and thank you to this audience also.